Well, September natural gas futures rallied on Wednesday as traders focused on hotter weather trends and positioned themselves ahead of tomorrow's EIA storage report. The report is expected to show a 19 billion cubic feet injection, which would be another relatively bullish number compared with the 5-year average build of around 33 billion cubic feet. If confirmed, it would provide further evidence that the storage surplus is finally shrinking at a meaningful pace. Tomorrow's rollover to October futures is also important. As you can see on the chart, the new front-month contract is already trading around $2.90, while the futures curve continues to rise toward January. In other words, the market is increasingly looking beyond the final weeks of summer and towards stronger fall and winter demand. The main bullish driver remains the weather. Forecasts have shifted hotter again, with above-normal temperatures expected across the Gulf Coast, Midwest, and Mid-Atlantic from roughly August 30th through September 8th. The maximum heat index area has also expanded, suggesting a greater probability of extreme temperatures and stronger cooling demand across these regions. As I suggested last week, several consecutive smaller-than-average storage builds could significantly change the fundamental picture, and fortunately for bulls, that scenario is unfolding even faster than expected. The storage surplus is now projected to fall toward just 104 billion cubic feet, compared with earlier expectations of roughly 150 billion cubic feet. More importantly, the daily surplus versus 5-year average chart shows a particularly sharp decline beginning toward the end of August. If that trend continues, the surplus could eventually approach zero, which would represent a major bullish shift heading into the expected increase in LNG feed gas demand and, shortly afterward, the heating season. And this is where the traditional bearish fall shoulder season may become much less important than usual. Traders rarely wait until winter demand actually arrives before reacting. The market typically starts pricing expected conditions several weeks, or even a couple of months, in advance. So if storage continues tightening while LNG demand strengthens, traders may simply look straight through the shoulder season and begin positioning for winter. In that environment, the question could gradually shift from whether natural gas can hold above $2.80 to when the market is ready to challenge the $3 target. From a technical perspective, September futures finally broke through and settled above the key $2.80 resistance level. As I expected yesterday, the main battle then shifted into the $2.80 to $2.85 zone, immediately bringing the falling 50-day moving average, currently near $2.90, into focus. However, tomorrow we switch our attention to October futures. The front-month contract has already rolled over, with October now trading around $2.90. From this level, it appears to be only a matter of time before the psychologically important $3 pivot is challenged. Of course, prices could initially pull back after testing the 50-day moving average. But if natural gas eventually breaks and settles above the 50-day MA, that would provide much stronger confirmation that the broader trend has finally reversed, similar to the bullish reversal pattern we saw back in May. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.